thing I'll tell you is that we have two of our Teaching Artist Affairs Committee members that are helping moderate this event. So I just want to put your attention to Abby and Amanda. You will know that it's them because Abby says tax questions. But there's Abby, and Amanda says finance questions. So if you have a tax-related question, just send a direct chat over to Abby. And if you have a finance question, send that over to Amanda. And the final thing I will say is this is a really idiosyncratic year for taxes and finances. And so we want to make sure that you can get those questions answered. But when framing the question, try to frame it in a way that you think would benefit the full group. Because I know we all have like really specific questions, but if there's a way to sort of frame it, because I think a lot of us are probably in similar situations. So without further ado, I'd like to introduce our two panelists. We have Dominic Comperatore and Joe Longthorne. Dominic is an actor, the founder of Empire Tax Prep, and a longtime friend of the Roundtable. He's done multiple events for us for multiple years, and we're always so thankful to have his expertise. And Joe is a new friend of the Roundtable. Joe is a New York City theatrical producer, and he's a financial consultant specifically for artists. And he's a content creator and runs the website Broadway Joe, which we'll make sure to put the Empire Tax Prep and Broadway Joe into the chat so you can follow them. But I'm gonna ask some intro questions to both of them, and then we're just gonna open up the floor. So you can start sending those questions now if you'd like to Abby and Amanda. But I'll start with Dominic. Dominic, it's 2021. It's been a—
Thank God.
It's been a unique year, but unfortunately we still have to think about 2020 because we're doing our taxes. So what are some unique trends that you're seeing as you're working on filing taxes for artists in 2020?
Well, the first trend that's not unique, I guess it's just more intense, is our tax system has gotten more chaotic, and that has been on an increasing prevalence over the last couple of years, and last year everything just kind of broke loose. So it's a little bit chaotic this year, definitely. The one thing I'm seeing, ironically, actually has to do a little bit more on the finance side. You know, for years, I've been talking to clients about the importance of an emergency fund and of funding your retirement from the day you start working. And it seems like this year, a lot more people are actually hearing that message for the first time and taking it to heart. So honestly, I think that's the biggest change I've seen this year.
Thank you. And Joe, I think it's hard for a lot of artists to even think about financial planning in general, but especially right now. So what are you seeing as opportunities right now for artists to start that are seeking some best practices or just to make some strategic choices while we're still in the middle of a pandemic?
Absolutely. Well, I'll echo Dominic in saying, I think one of the nice things that's happened over the last year, at least in a sort of a year of chaos, is folks are starting to take things really seriously, which is great. Folks are self-educating more. They're learning more about the tools that are available to them in terms of banking, in terms of new technology, financial apps and applications you can find on your phone and over the internet. So there are a lot of tools out there that can make personal finance easier and more accessible, less hurdles for you. So it's really nice to see folks moving in that direction. And yeah, in a year where, you know, a lot of people probably thought, I don't necessarily need an emergency fund for my life. And now the biggest emergency of all came along. And I think a lot of us learned that no one can escape that sometimes. And so it's good to just be prepared and to be able to support yourself in those times of need. So just taking the additional time, I think, has been great this year to learn how to be conscientious about your income, your spending, your saving, and your giving, and the ways that you can be charitable as well.
Great. All right, well, we're going to start opening this up. Abby and Amanda, are you starting to receive questions? Great. Okay, so I'm going to throw it over to Abby to start us off.
Cool. And we have some that were sent to us ahead of time, so we'll have those too. Dominic, How will the new Biden bill affect claiming unemployment on taxes for New York City residents?
Great question. So as you know, just a little over a week ago, Congress changed the tax law midstream in the middle of our 2021 tax season that affects the 2020 tax returns. And so we're actually have a filing cabinet that's bursting at the seams with stuff we froze in the preparation process. So by the way, you folks, if you're working with tax folks out there, please be patient. We're all waiting for information right now. But the big change that happened is that the IRS on your federal return has exempted the first $10,200 of your unemployment. Now, this is a huge, huge help to most of you who have received unemployment, which I'm assuming is a large portion of you. The other reason this is helping is that most of you, had you filed your taxes early in the season, probably realized that you had been under withheld on both the federal and the state. And part of that reason was not from the unemployment agency's fault. It was lack of communication from Congress when they added on the supplemental unemployment as to whether or not that portion was going to be taxable. And they left the unemployment agencies, the state agencies, completely in the dark about that. So our state agencies, before we start throwing stones at them, actually tried to help us out in the middle of the pandemic and said, we don't want to tax people on something before we're sure it's going to be taxable. Okay, so fast forward to about a week ago, Congress passed the rule saying that $10,200 of unemployment will not be taxed. Some states are following the federal's lead, and some states are not following the federal's lead. And two of the states, well, that we know right now is New Jersey and California. Doesn't matter because they don't tax your unemployment benefits anyway. So no change if you're a New Jersey or California resident. New York, however, is a big question mark. New York taxes your unemployment benefits currently, and we are still waiting to hear from them if they're going to follow the federal. So if you live in New York, what we're currently recommending to people is don't file your taxes until you hear from New York.
Thank you. Amanda, over to you.
I haven't got any finance questions directly in the chat, so I'm going to be referencing the earlier ones. Just a reminder to everybody, if you do have any, please reach out to me.
I'd be happy also to just piggyback on the last question from a personal finance side as well quickly. Sure. Just to say, you know, as a practice, this is something I do and have started doing this year, and it's what I recommend to friends as well. Knowing that you have income that's coming in that is taxable income, but the tax is not necessarily being withheld. One thing I recommend to folks is to create sort of a separate place to put that money. Personally, for me, that's an online bank account. I keep an account with Capital One. It's just an example, but there are many great banks out there. And every time I get paid income, let's say it's even a contractor payment, which a lot of folks here, I'm sure, receive payments that end up being 1099 at the end of the year. I personally like to I sort of self-assess what my tax rate might be. I take about 25% of that payment and I stash it away right away and put it into a separate place all year long that I know that I'm not going to touch it. I know where it is, and that at the end of the year, come tax time, I can go right to that account and I've sort of set aside everything I need to pay my tax assessment at the end of the year. So that's just a practice I recommend to a lot of folks as well. I think it's helpful to put it away where you can't touch it, where you might not be tempted to use it for something else, for Christmas gifts, for holiday gifts, for sort of self-joy and things like that.
I actually have a follow-up question for you, Joe,
Yeah.
based on what you just said. Would you recommend for people that are living in New York City and also have to pay city taxes to do 20% or higher? Is there a, for those that have varied incomes, if your income has changed, is there a kind of general percentage that you would recommend that people set aside for 1099 untaxed income?
Sure. It's going to change depending on the overall income of the person. You know, people that are living, Dominic might even know a little bit more about this, but folks that are living in the sort of $40,000 to $70,000 range, I think 25–30% is a fair assessment. Obviously, that number continues to go up and up the more money you make. And if you're making less than that, your assessment might well be lower than that. But I think, using that as a ballpark, and then just checking in. If you do have an accountant you work with, you can check in with them for support throughout the year to see if you're on track and sort of meeting the right rate. But that's a good ballpark, I think, for most people.
Yeah, we generally recommend the same ballpark, generally 20 to 30% if you have 1099 income. And again, it can vary year to year very dramatically, not only on the work you get on 1099, but also on whatever you're booking on the W-2 side and which payroll companies you're working for. There are some payroll companies out there that are notorious for under withholding artists. So we just say as a broad generalization, 20 to 30, and you can have that tax, you want to hold tax back as much as you can. Be conservative on that side. I'm in full agreement with Joe here. Either get a separate account to put it in, make sure that if you have unemployment coming in, that you're checking those boxes to have them withhold the tax. And if it's not currently coming out, you can go onto the website right now and change that. And the other thing that you want to do is when you get hired for jobs, they're sending you a new W-4. I recommend that you withhold aggressively on the W-2 side, which is a section we'll probably come back to around later. But I'm fully for withholding more money now so that you have more options later. All right, and this necessarily might not be the same advice that you're going to hear at Thanksgiving from the well-intentioned male relative that I like to call Uncle Bob. Okay, Uncle Bob is the very well-intentioned guy who's going to say, hey, what are you doing? You're having too much money withheld. You're giving the government a free loan. That's your money. You should have that right now. Okay, and that might be great for Uncle Bob, but our lives in the arts are very different than Uncle Bob's. So to cut it short, I agree. You should have more money withheld, give you more options later.
All right, Dominic, we have some follow-up questions based on where we are in the conversation. So I'm going to give you a few, and they'll relate to each other. So I'll let you sort of navigate through them. One thing you said sort of at the end of your first spiel was you said, don't file your taxes until you hear from New York. Can you say what you mean specifically about that?
We are literally waiting to hear whether New York is going to follow the federal in this. So currently, as the law stands, they're not following it, but we believe that there's probably going to be a lot of pressure building on Albany right now to change that law. We just don't know if it's going to happen.
And how will folks find out? Where is the best place to look?
Probably going to be all over the news.
Great. And then if folks did file their taxes already,
do not amend. Do not amend your taxes. So the IRS already issued guidance on this, and thank God they said, do not send us amended tax returns. We will figure out a way to get you the refund. Okay. That's probably factoring into why we haven't heard from New York yet as well, because if New York offers the same thing, they're going to have to offer the same type of solution or not, you know, so. But the IRS is currently saying do not send an amended return for that.
Great. Okay, next question. Can temporarily relocating to another state during COVID affect how one should file, even if the teaching artist work was remote?
A general answer to that is no. A temporary relocation does not change your domicile. You can only have one domicile at a time, and domicile is typically the place that you have the most connections to and that you're most likely to return to. So if you just got out of Dodge for COVID, congratulations, but you're still a New York City resident.
Awesome. I'll do one more and then Amanda can jump in. Do you have any suggested free resources to help do taxes, or maybe we'll add in low cost? Yeah, we'll start there, resources.
Yeah, sure. So the one standard bearer that I would recommend would be a VITA Center. That's called Volunteer Income Tax Assistance. And these are organizations that are authorized by the IRS to give free or low-cost tax help in certain communities. Actors Equity actually has one here in New York City. The problem is that last year and this year, they're all closed down because of COVID. But in general, that's the one I would recommend. If you want to try the completely do-it-yourself model, you can go to irs.gov, and if you're below a certain income level, you can actually file for free there through certain third-party providers. So there are a lot of commercial providers out there that will do that. The one that I like the least, and in fact have disdain for, is TurboTax, because they have a decades-long history of cheating people. So I'm not in favor of that one. But if you have to do it on your own, I would start at irs.gov, or see if there is maybe now in your community a local VITA center opening up.
No, any follow-up questions? Are you good, Abby? Cool. Why is this a good time to be establishing financial practices for artists and teaching artists? I guess that's a Joe question.
Sure. I happen to think this is a good time because the one thing that did happen in this pandemic, and it probably happened to all different folks in all different kinds of ways, but I think it was a chance to hit a reset button on our lives and our practices in a big way. A chance to explore some new ideas, some new assets, and some new tools that might be available to you. Just as a general example, the way I grew up was you would open a bank account with a brick and mortar bank because you had to go to the bank to take your money out of the ATM that was associated with that bank. It was very physical, it was sort of physically oriented. Whatever had the most ATMs near to you, that was what you banked with. And in my case, growing up in New Jersey, that was Chase Bank. Eventually I moved to Boston and went to college, and there was no Chase Bank at all in Boston. So I had to open up Bank of America, and it's all just sort of tethered to these banks that happen to be where you are at any given time. I have learned about online banks and just simply fallen in love with them. I think there are such great online banks out there. Ally Bank is one great example. And these are banks with no offices, no physical footprint. It's all done online. It's all FDIC insured, which means that your money is insured up to $250,000 is sort of the standard insurance. So that if something does ultimately happen to the bank, and nothing is intended to happen, I'm just saying it as a disclaimer, your money is safe, it is taken care of, and it's going to be available to you through this insurance. So learning about these online banks that carry higher interest rates because they don't have brick and mortar footprint, what I mean by that is the money you keep there is yielding a better interest than the Chase Bank or the Bank of America. For example, in a Chase savings account, you'd get 0.01 interest on your savings, versus the online banks are now offering 0.5%. It's small in the grand scheme of things, but it is 50 times what the brick and mortar banks are offering. So I think this has been a great time to just learn more about these institutions, what they can offer you. Things are changing in the economy all the time right now, and those interest rates were historically a lot higher. They were about 1.6% before the pandemic. So there's hope that they'll go back up in the future as well. But this is a great time to get started sort of learning about these systems, how they work, so that when these great benefits do come back to where they were at pre-pandemic levels, you're already taking advantage of them and yielding more interest for the future and things like that.
I'd like to follow up on that. One thing that I think is a great opportunity is that across the board this year, we have all pretty much learned to live on less. And one of the biggest obstacles to retirement, I think Joe will probably agree with me on this, is that people start too late. Yep. And they save too little. And the reason is they always put it off. I'm going to do it later when I can afford to. And that day never comes unless you are really strict on your budget. We have all learned to live on less this year. And I would encourage people to look at the budget that you've adopted during COVID and see how much longer you can extend that as your income increases. The biggest enemy to retirement savings is what we call lifestyle inflation. The more money comes in, the more money you spend. Mm-hmm. If you can fix your budget where it is right now and take the excess that comes in as you start earning more money again and funneling that into a retirement account, you're going to achieve your financial freedom a heck of a lot sooner than you otherwise would.
Yeah, and adding on to just that as well, there is no bad time to start these practices. I think folks might ask, you know, with the uncertainty in the world, is this a time that I should wait? Should I put this off for a little while longer even? And to Dominic's point, the sooner you start, the better off you're going to be in the long run. We're familiar with this concept of compound interest, the idea that when you put your money to good use, it will compound over time and just grow and grow and grow on itself in this sort of fantastic exponential way. So the moral of the story is you just have to get started. The sooner you start, the better. I read a very interesting statistic recently. Folks here might find it interesting that if you want to be a millionaire, let's say, and we all would hope to retire millionaires, I would think. If you start investing at 30, you're putting away about $250 a month. Versus if you started when you were 20 years old, you'd only have to put away $90 a month to become a millionaire at the same age, at 60 years old. So it just speaks to the power of the sooner you get started, you're going to be better off in the long run.
Thank you. Next question. These are all over the place and all just so juicy. Dominic, some folks have questions about emergency funds and emergency relief funds. So the Roundtable has emergency art funds. How can those impact income for tax purposes, or how do they?
Well, a lot of these grants that were given out are tax-free. But if you got a grant, you need to actually check with the organization that gave it to you to find out whether or not it's taxable. They're the ones to ask about that.
And is it the organization that decides if it becomes a 1099 or if it's...
The organization who is funding the grant will know whether or not what they're giving you is taxable or not.
Great.
So, but what we're seeing in general, that most of these are tax-free grants, but I would not take that for granted. I would ask them.
Perfect. Amanda, you want me to do one more?
Sure.
Cool. All right, Dominic, someone has moved their studio work into their apartment, which I know a lot of people have. Great, perfect example. Yeah. A lot of folks have done this. I've heard this all over. So how can folks report part of their apartment rent as like small business expense?
Yeah, so what we're talking about is called the home office deduction. And the main thing you need to know about a home office deduction is it's a place in your apartment that you use for work and only for work. If you mix it with any personal use, it is no longer a home office. So the biggest example, I do all my work on my couch, so can I write off a portion of my couch? The answer is no. All right. If you have a separate bedroom that you use to do your office, but also your yoga, and also is a spare bedroom, and it's no, okay? This is hard for most of us in New York City because we don't always, the rent's so expensive, who can afford a spare room just for one use? However, in the age of COVID, this is becoming more and more necessary. And so a lot of us have carved out maybe a corner of a room where you have a desk and a space for a chair and it's only used for business. You can certainly take that area right there. Another area that we're seeing is very common and has been common are voiceover artists. People have taken a closet and transformed it into a voiceover booth, and they use it only for voiceover. They're taking that closet space. Now, mind you, I'm saying they have transformed their closet, okay? They are not just going into the existing clothes there to use that for the sound dampening. That would be dual use and that's not deductible.
And if folks have determined which space they'll use and that might qualify based on those grounds, how does one account for that in their taxes?
You would need the total square footage of your apartment, the total square footage of the workspace, and then any expenses that relate to the apartment. That would be rent, utilities, renter's insurance. Those are the biggest categories.
Thank you. Amanda?
I wanted to do a follow-up question for Joe around online banks because you highly recommended online banks. Are there any material differences between online banking and obviously banking in person in terms of transactions and any other sort of benefits? I know you mentioned interest, but are there other ones that you want to share with the group or that you'd recommend to freelance teaching artists?
Sure. Yeah, I would say there are definitely more benefits, to be honest. In my experience, one other example would be, you do get issued a debit card from these online banks, and typically the biggest network would be the Allpoint network of ATMs across the country. It's a network of thousands and thousands of ATMs that are completely fee-free. They work directly with these online banks, so you can go to any of these ATMs and take cash out fee-free, meaning no ATM fee. And then on top of that, if you are at an ATM in a deli, let's say, and it's not part of the Allpoint network and it does carry a fee, you can still take cash out, you pay the fee, and a lot of these banks will reimburse you on your statement up to a certain amount for those fees. So my bank, for example, will reimburse me up to $10 a month in ATM fees if I happen to withdraw from an ATM that's not part of the Allpoint network. I've found that the customer service is sort of equally wonderful, if not more exceptional. I think if something does happen, if there's sort of fraud or a need to talk to a representative, you can get them on the phone very quickly because they still have this wide network of dedicated staff that are available to you. And then I guess going above and beyond online banks, one other thing folks could consider would be working directly with a credit union. And for those that are unfamiliar, credit unions essentially function in all the same ways that banks do. You can carry checkings and savings accounts. They can lend you money for mortgages and cars. The difference would be a credit union is a nonprofit institution, whereas a bank is a for-profit institution. That's something that I learned in the last year. I'm not sure that everyone knows that, but banks like Chase and JP Morgan Chase and Bank of America are for-profit versus there are wonderful credit unions out there that they look after you in a community in a different way because they're not, their end game is not creating profit margin. It's sort of supporting the customer base directly. So if you live in an area that has a credit union, they tend to be sort of locally organized and community based. And we often see them for, veterans of the military and folks that identify in specific community groups. That's a great institution to work with, a credit union as well.
I'm a huge fan of credit unions also, I agree, and the online banks. I like the credit unions over the major banks because A, they didn't bankrupt our economy the first time around, and they didn't get any payout from us. And you are actually supporting your community when you go to a community bank. The other good thing about having a community bank is that some in-person services are offered for free at a lot of these places. Like if you need a notary, a lot of credit unions will offer that for free. And if some of you are applying for the affordable housing lotteries, you may have documents that you need to get notarized that would be free at most credit unions.
I guess next follow-up question is, with so little income coming in for artists, what are some tangible steps they can take to either stabilize or work with what they have?
Good question. And I think it's a matter of creating priorities for yourself. I think a priority number one for everyone should be establishing an emergency fund that is there to catch you in case you need it. And financial experts would recommend that be between 3 and 6 months of your expenses. So 3 months on the low end, 6 months on the high end, and then everything above and beyond that should start to become invested in funds and things for the future. But that's just a great place to get started. The second thing I think most people would recommend is to eliminate high interest debt. That's the thing you really want to focus on. If you're carrying credit card debt that has high interest, and we're talking about 15, 16, upwards of 19, 20% interest, that is called bad debt. That is gonna, in the same way that when you invest money in the stock market for your retirement and it compounds in wonderful ways and grows, credit card debt, ultimately, if left unattended, will compound in the worst way. And it's just going to continue to snowball and get worse and worse and worse for you. So that is something that is definitely worth keeping an eye on and prioritizing. Versus, I'll just touch on it quickly because we identified that as bad debt. There are also examples of good debt in our lives. So that might be debt you take out to pursue an education. That might be debt, a mortgage on a house is considered good debt because those interest rates are much lower. They're hopefully closer to 3.5% versus the 15 to 20% you're going to pay on the credit card. So while you're working on your good debt, you can also simultaneously be investing. And we hope to expect average returns of closer to 10% in the stock market. So if you're earning 10% on your investments, but paying 3% against your good debt, I know it's a lot of numbers, but the idea being that those two can still happen simultaneously and you can work on those side by side. But emergency funds and prioritizing the high interest debt are two really good places to start.
It's funny, Joe, did people used to like roll their eyes at you when you would say 3 to 6 months? Like, what are you, crazy? Why would I ever need that?
Yeah, absolutely. I
Yeah.
mean, and I was rolling my eyes at myself at one point, and then you learn that you really do need it. Money becomes so emotional is the other thing. And, you know, just having the money set aside to know that you can take care of yourself in a time of emergency, it gives you really good peace of mind and clarity, and actually allows you to climb out of the hole a lot quicker.
Artists, emotional, Joe? I can't believe you would say such a thing. Okay, Dominic, we have a compliance question. How exciting. Someone has never received their 1099 from an employer, but said they would need to report the income, though it was paid via PayPal. They're concerned they just didn't get the proper documentation. Can you share sort of what the responsibility is for the individual and maybe also for the employer,
Sure.
just so everyone
Absolutely.
knows?
So this is a couple things on this topic. This was cash or independent contractor income. In other words, there was no tax taken out, and they were not considered an employee. They're considered self-employed. And whether or not you received a form, you need to report the income. Now, you want to avoid a situation where you might be double counting that income. And the only way to do that is to actually call up the person who gave you the money and say, hey, are you sending me a 1099? Because it's not uncommon for these forms to get lost in the mail. So you need to account for the income and report it regardless, and check with the person that paid you to see if they're sending you a 1099. Okay. This generally leads to the follow-up question is, hey, Dom, you know, I kind of maybe earned some money and I didn't really get a form for it. So do I really got to report that? And the answer is yes. Then I get a question, well, you know what? I earned less than $600. I heard that if you earn less than $600, you don't have to report it. That is completely unequivocally false, folks. Okay, we are required to report every dollar that comes in. The $600 threshold applies to the person who paid you, not to your requirement to report it. Okay, so report every dollar.
That was very clear. Thank you very much. I really liked the hand motion because
Thanks.
Yeah, I'm a very visual learner, so I'm just going to take that with me. Joe, did you want to add on something to that?
I guess what I'll add in terms of, you know, being able to report and sort of understand how much you're taking in as well, a good practice to add to your life is pretty specifically tracking your income and expenses. It's super duper helpful. One thing I've wrote about on my blog in the past is this idea of the feels like temperature. I think a lot of people get in trouble with this, where it's this idea of what the real temperature is and then what the feels like temperature. And my sort of musical theater moment here is Al Roker. You know, I think of him when I think of The Weatherman, because growing up in New Jersey, also was fantastic in Broadway's Waitress, if anyone had the chance to see him. But Al Roker would talk about the feels like temperature on TV. And it's, to me, in the money world, it's this idea of, well, I think I made this much money. It feels like I made this much. And what is that in actuality? Because that can be very different. And it correlates to, it feels like I spent this much money, but what did I actually spend? It's very important to zero in on that, because you start to run into this dangerous territory of maybe you're spending more than you're making. And that's how you're accumulating this credit card debt, this high interest bad debt. But it speaks to what Dominic was saying about sort of knowing how to specifically report your income, how to specifically report your expenses and get the most out of your deductions as well, in terms of what you can do with your home office, what you can do with your charitable giving when it comes to your taxes. But if you're tracking everything, it gives you the power then to sort of get more out of it as well.
Tracking your expenses is everything. I mean, that's, you know, when I was a kid, my mom told me that when things were tight and raising things in our family, she would write down every purchase. She would buy us a pack of gum for 25 cents at the corner, or I think 5 cents back then. And she would write it down on a notebook. And I thought she was insane. It wasn't until I started doing that it completely revolutionized my saving strategy. Most of us have no idea what we actually spend. It's the whole temperature thing you were just referring to. And frankly, what I recommend to people is for 30 days, keep a notebook and physically write down every dollar that comes out of your pocket, whether it's a transfer to someone, whether it's a credit card payment, whether it's an IOU or a dollar for a slice of pizza, and write it down. And by the end of that month, you will be shocked at two things. A, how much money you actually spent, and B, all the crap that you actually spent it on that you didn't really need. And it's going to be a huge wake-up call. And that's the first step in formulating the budget. You know, when we're talking about credit card debt, saving for retirement, emergency funds, the budget that you have should really be the core of all of it. I can't stress that enough. And this is where most people go wrong. And it's the strongest tool if you can really get that under control.
And I'll lift up from the chat. Justin has asked, any apps you recommend for tracking expenses? Joe or Dominic?
So I'll say personally, I've heard of some and I'll name a few, but what I do is I use a Google Sheets budget that I've created for myself. I think it can be as simple as that, just a place that's available to you that makes sense to you. But yeah, there are apps out there and I've heard nice things. You could look at Mint as an example, as a subsidiary of QuickBooks. There's another one called YNAB, YNAB, which stands for You Need a Budget. Folks seem to like working with that. Personal Capital is an app you could look at, which helps track your overall net worth as well. So it's just worth investigating and sort of getting a look at, they're all a little bit different in their interfaces and what works the best for you. And for me, it happens to be sort of, it's the modern old fashioned version of just pencil and paper. I just do everything in Google Sheets and I keep track of it myself.
Cool.
Yep.
We are trying, I'm getting a lot of questions in. So if you have sent in a question, you haven't heard it yet, know that I have them all logged and we'll get to as many as we possibly can. Dominic, our asker asks, I was thinking that my W-2 refund would compensate for my 1099s over the past couple of years, and I'm owing more and more. What has changed with withholding for W-2 employees over the past couple of years? And will it continue for more? I heard vaguely that Trump changed federal withholding.
Yeah. So basically, Trump reduced some of the withholding, and so people are having less withheld than they were otherwise accustomed to. The other thing that could have changed is that you might be working for a different employer. There are some payroll companies, and by the way, write these two companies down if you have a pen. One is Talent Partners, and the other is Extreme Reach. If you're ever filling out paperwork for a job and you see either of those two companies, you want to hold extremely aggressively because they tend to under-withhold. The other thing that might be happening is you might be working for several W-2s all at a low level. Every employer withholds you at the marginal tax bracket they expect you to wind up in. So, and they don't know about each other. So if you have one employer that's only paying you $10,000, they're going to think, oh, you're going to wind up in a really low tax bracket. But what if you have 5 of them? Okay, you're going to be up around $50,000 middle income, then you're suddenly being taxed at marginal rate of around 22% on that, on the federal. And so that's another way you can be under withheld. Third way you can be under withheld is a change in your deductions because of the nature of your work. And a fourth way is maybe you're earning more on 1099 than you were in the past. Now, one thing that people need to know about 1099 income that most are not aware of is that you are actually taxed more heavily on your 1099 income than you are on your W-2. Most people think that if I'm working on 1099, all I have to do is do estimated payments. It's not the same. You're actually paying more tax by working that way. It's why people want you to work as independent contractors.
Thank you. Amanda.
Can you talk novices like some of us through stocks and bonds, and what is the difference?
Sure, it's a nice question. So just to lay it out in the most basic way, a stock is a share of a company. So what that means is when you buy a stock in the stock market, you become a part owner of that company. You own, and it could be a microscopic share, but you are a microscopic owner of the company. So this is a way to sort of enter the stock market, to sort of grow with the company as the company is hopefully profitable and continues to post profits, and the price of that stock goes up. That share that you bought, let's say you bought something $10, it might go up to $15. That one singular share then becomes worth $15. You've made $5 with that company. The difference being, maybe Dominic can jump in. I don't know the sort of dictionary definition of a bond, but a bond is more of a safe, secure asset where you can invest in these bonds that fluctuate much. They don't fluctuate as much as stocks do. They sort of stay in more of a tighter range, but they have higher yields on them. So the bonds themselves, you can expect to generate a sort of stable amount of return from the bond. They're not going to grow as much as stocks might grow, but they're also not going to go down as low as a stock might go either. It sort of lives in the middle, and they'll pay higher yields out. So what I mean by that is you might hold a bond that has a certain percentage of yield, and then 4 times a year, every quarter, it's going to pay out a dividend to you at that rate. So in terms of retirement, when folks move through their life and you grow older and you are getting to the point where you need access to your retirement monies and you don't want your retirement monies to fluctuate as much, you start to move from investing more into stocks towards putting more of your portfolio into bonds, because it helps even out the portfolio. In the case of last March, when the stock market took a gigantic nosedive, those older folks that were hopefully invested more heavily in bonds felt less of the impact on their lives and on their portfolio because the bonds didn't move as much as the stocks did. So it helps them sort of weather, the storms within the stock market, and it becomes much less aggressive of an investing strategy as you get older and older.
Yeah, I can comment on that. So basically, as Joe said, when you buy stock, you're buying an ownership share in the company. In a bond, you're actually loaning the company money. Okay, and if the company is that the entity you're loaning to is considered stable, they don't have to pay you as much interest because they're reliable, i.e. U.S. Treasuries. If they are a junk bond, you guys know that term, that means they're riskier, so they're going to pay more interest for that. Now, in general, with investing for retirement, usually use a combination of stocks and bonds to get there. And you want to think of stocks as your main growth engine. Stocks are going to get you to your goal of where you want to be to grow that nest egg. And then once you get close to retirement, usually for most people, this is within 10 years of your retirement date, you want to start look at what's called income preservation. So you want to take portions of that and put it in a safe way that's not going to fluctuate as much as the stocks are. It's the stuff you're going to live on. And the closer you get to that point, the more you're going to want to shift into bonds.
And particularly important nowadays, I would say, where pensions aren't as common as they used to be. So, back in the day, my grandparents, for as an example, retired and are living off their pensions. It's a fixed income that comes to them from their previous employer until the day that they die. They're going to get this pension. They don't really exist as much as they used to. But you might have a pension if you're a teacher, if you're working inside of education or a nonprofit or government work. But otherwise, it's been widely replaced with, I'm sure people are more familiar with 401k as a retirement vehicle that's been introduced and is available to lots of folks now. And that is a sort of save at your own rate vehicle. But when you save, you invest, and then eventually you spend the money, you withdraw and you use it in your retirement. And there is the chance if you don't spend at the right rate, then you could run out of that money eventually. It's not fixed. It's not going to last necessarily the rest of your life in a fixed way. So that's where bonds might be important in an investment strategy. They start to create some more fixed income for you as well as the stability.
I also want to address something because it sounded like someone was addressing stocks from the point of being a beginner. And one thing I need to bring to your attention is there are a lot of companies and a lot of apps out there that are advertising you, saying, look how easy it is to go and pick and choose stocks and trade them. And won't you please come trade with us and we'll make it sexy and easy. This is playing with fire. The problem with most stocks, and this is the way our parents grew up in the stock market, is the idea that I or some guru financial advisor can predict what that stock is going to do next month. Okay. Time after time after time, we have been proven horrible at guessing what the stocks are going to do. The financial advisors who we often pay fees to do this for us have also proven horrible at predicting what's going to happen in the future. This fact gave rise to a type of stock investing called index investing. And index investing is where you say, you know what, we're not going to try and beat the market. We're just going to try and match the average of the market. And when we do that, we can do it for a lot less money. So if you watch financial shows, Jim Cramer running around like a mad guy, crazy, investment magazines with the cocky guy on the front cover, okay, they all do great for about 1 year, 2 years, but none of them can do it repeatedly over the long term. And if they could, they'd be more famous than Warren Buffett, okay? Actual investing should be rather boring and steady. But what's exciting is the compounding and the results that you get. The way I liken it is that suppose if no one has been able to beat the average of the stock market, why are you paying extra for them to do it for you? That's like saying you're driving cross country, no one can go faster than 55 miles an hour, and every time you change lanes, it's going to cost you money. So do you want to be the person that's just going and cruising, knowing you're going to get there eventually the same way? Or are you going to be hiring a driver and driving a gas guzzler, changing lanes back and forth? That's the exciting way, and that's why the way a lot of apps are encouraging you to trade right now. And so I would encourage all of you to look up index investing and low-cost mutual funds. And if you want some deeper reading, Google a guy named John Bogle. That's Bogle. He is the godfather and the founder of this concept.
There's a great book I'll recommend. I can drop it in the chat, but The Simple Path to Wealth by J.L. Collins. He sort of explains the Bogle mindset, the grandfather of Vanguard, and just how simple it can be and how effective simple is, that you're just investing for the long term in a very simple, steady way. And to Dominic's point, statistically, history has shown that it beats the quote unquote experts 99% of the time.
And it does so cheaper.
Yeah.
Awesome. Dominic, can you repeat? You said index investing, and then you said something mutual funds. What was the other?
Yeah, so a mutual fund is simply, a mutual fund is a collection of different stocks. And you can have different types of mutual funds. You can have a mutual fund that says that's just a collection of tech stocks, a mutual fund that's a collection of utility stocks, or you can have also what's known as a total market mutual fund. And that's the kind I like the best, a total market index fund. An index is merely a measurement tool. So index means we look at an entire segment of the market or the entire market as a whole, our measuring tool, our index says this is what it does on average. And a mutual fund that's an index will try to match that average. So all they're doing is they're programming their computers to match the average. And they can do so for a lot lower cost and a lot less activity. And those two things combined give you much better gas mileage.
Thank you. All right. Dominic, any advice on how to move forward if the IRS is still saying they haven't received your amended refund from the previous year? Where does one go for assistance?
Sit tight.
If it's
Sit tight. Sit tight. The IRS got way behind on amended returns. Generally, first of all, amended returns traditionally all had to be paper filed, which means a human being has to look through every page of the return when you send it in. And thanks to continual cuts from Congress, the IRS staff has shrunk. That was pre-pandemic. Post-pandemic, their budget got even tighter and they had more work thrown on them. So we're seeing wait times of amended returns from between 9 and 12 months right now. So I would say just sit tight, you will hear from them. But if you do need to send in an amended return, I do recommend that if you do it, you want to send it certified mail with return receipt. So return receipt is this additional green postcard that you fill out and it's attached to the document, to the mail. And so when someone at the IRS signs for it, that postcard comes back to you and it's your proof that you actually sent it in. So the IRS can't say, guess what, we lost it. You can say, no, actually you lost it. Here's my return receipt.
Wow. And should folks fill out their 2020 taxes? So they should move ahead and do that anyway, even if they haven't gotten their amendment back?
Returns from prior years?
No, should they continue on with this year if they have not gotten their prior year's amendment settled?
No, don't wait on your prior year's amendment to file the current year.
Great. I'll do one more. Did the tax filing deadline extend into May? And will the deadline contribute to your IRA? And are RMDs waived for 2021 as they were in 2020? That's a three-part.
So let me start with what's an RMD, because I'm sure a lot of people are asking that right now. RMD is called required minimum distribution. So if you have an inherited IRA account from a relative, or if you are of the age where you were required to start taking distributions, you have something called an RMD, which is the required minimum distribution. So that's the amount every year that you are required to take out of your account. And if you don't, you get a heavy tax penalty on it. So, but those of you who are in that situation are aware of that. They waived the RMD requirement for 2020. They have not waived it for 2021. So if you have an RMD for 2021, you have until December 31st of this year to take the money out of the account. As far as contributions to IRAs and solo 401ks, last year when they extended the tax deadline to July, they extended the contribution deadline for those the same way. And it appears that they're doing the same thing now for this current extension. And that current extension is May 17th.
And that's the current extension to file all income taxes for 2020, just to clarify for the audience.
Yeah, well, we're yes and no. So again, because the states, we're seeing which states are complying. So currently, New York, New Jersey, and California have all extended it as well. But people, from other areas of the country need to check with their states.
And question from the audience. What advice would you give for someone who bought into a sexy stock app? Their comment, not mine, although I probably would have said the same, like Acorns, who wants to move it out into a safer bond option. The person writes, I got overwhelmed trying to use Vanguard by myself, so I opted for the app. Is it easier than I think?
Real quick on that, if you got overwhelmed on Vanguard, Vanguard is the founder of the concept of the index fund, but they have an outdated website that confuses a lot of first-time investors. If you want to stay with that type of investing, Fidelity has a much friendlier website to get started with. So I would consider that as one of your options.
Yeah, and the other point to make, there are some of these financial tech apps that are really good at what they do as well. They charge a fee for the services they offer. The one I'll throw out there for some research to folks is Betterment. Betterment, I think, is a nice app, a nice institution where you can run an IRA with Betterment. You can save in a number of different vehicles, and it's a robo-advisor app. So the idea behind it is a sort of team of robots, a collective AI, is constantly looking at your investments for you. They're allocating your investments into stocks, into bonds, into a mix of all different kinds of things. And then they're going to charge an expense fee on that. They're going to charge, I believe it's about 1%. I need to double check. So that is significant in the long run. 1% when your money becomes a sort of very large sum will be significant. But I think in the short term, if you're just getting started and you're just trying to learn and you want to get started, but you don't exactly know how, that is a place to start. And then what people will do, you could open up a Vanguard account later or a Fidelity account. And once you feel comfortable to do it on your own, you can begin the process of a rollover. You can roll over your IRA from one institution to another. Apologies, there's something on the road out there. And they'll do that with you and for you, and sort of becomes this process where they move your account over for you. And then you can start to control it on your own. So that's another option. Betterment would be worth looking at.
Yeah, I would agree with that too. But the sooner you can move it off to low cost, because that 1% for laymen doesn't sound like a lot. 1% in investing is enormous.
Yep.
Okay, so when you hear 1%, that is an expensive way to invest. Some of the Vanguard funds are like 0.06 expense ratio as opposed to 0.1. It's a huge difference. And Fidelity, because they're trying to get it on Vanguard's business right now, actually have some that are zero, cost you nothing with no minimum. Now, granted, later on, they might find a way to charge you for something, but for right now, that's the cheapest way you can get in. So, and their website's actually pretty straightforward. So with my clients who are just starting out and getting a little stymied with Vanguard, most of them have had reasonable success with Fidelity. It's been a lot easier, so.
Okay, Dominic. From the crowd, as I was doing my taxes, my return became much lower after I added my 1099-G
Your refund
unemployment.
became lower. The return is the document, the refund is the amount of money you're getting back. Sorry, I have to just correct that there because that's a common confusion of terms.
Great. Okay.
Refund
I'm
kept dropping.
gonna reread it and then finish the
Okay,
question.
great,
New
okay.
terminology.
Yeah.
As I was doing my taxes, my refund became much lower after I added my 1099-G or unemployment tax form. Why is that when taxes were taken out every time already?
Well, we addressed this actually earlier. Is first of all, when your unemployment takes out taxes, it's at a fixed rate, generally 10%, and that might be lower than your marginal tax rate. That's one. The other reason this year, when you might see that trend even more exaggerated, is that when you check that box to have them withhold tax on your unemployment, they were only withholding tax on a portion of the unemployment, not the entire amount.
Amanda?
Question from the crowd. In terms of Betterment, I'm a long-term Vanguard investor, and I've thought about Betterment a lot because of the tax loss harvesting option. But I feel like I'm in the gray area of it financially being worth it for me. How can I calculate that?
I'll let Dominic speak to the tax loss harvesting, but I would say if you're comfortable at Vanguard and you're already there, to our earlier point, you're already on the path to success. You can find these low-cost funds there. You can invest in total market funds. You could literally just pick one, probably the total market fund, something like a VTI or VTSAX. It's not a recommendation, just something to research. But those are low-cost funds that you could just invest in those for the rest of your days, and you would get the average returns you need to retire comfortably. By the time you're sort of reaching your proposed retirement age. So I think I would avoid the fees if it were me. I think I would stay with Vanguard and sort of keep it simple, keep it low cost, and just continue to move forward from there.
Yeah, I would agree. I would check. I would first of all stick with the low cost. And secondly, with the tax loss harvesting, if you're asking us that question, that makes me wonder how well you understand the concept. And this is the kind of concept that I don't want to talk about in general, because this is going to be particular to each person's financial situation. So a lot of these apps will advertise their ability to tax loss harvest as if you just click here and click there and look how easy that was. It's not that easy. First thing I'll say. So if you are unsure about what you're doing, you might want to seek help from a financial advisor. And if you are seeking help from a financial advisor, I can give two recommendations in the kind of advisor to look for. First thing you want to look for is I would recommend going with what's called a fee-only advisor. So that means someone who's going to charge you for the hour of time that they're looking over your documents. They are not charging you what's called a percentage of assets under management. So they're not charging you on the whole portfolio. They're charging you on the hour of time, okay? The other big thing, and this is huge, you want to find someone who is independent. That means they are not getting any kickback from the investment banks, all right? So those are the two big things I would look for if you do need to seek advice.
Yeah, and one more thing to add on the subject of tax loss and just the idea of paying tax on your investment. worth looking into the difference between short-term capital gains and long-term capital gains. And in theory, it shouldn't matter so much. I think what we're both proposing and sort of suggesting is you want to keep investing for the long term so that your investments are sitting in one place for a very, very long time to grow and compound. But if you hold your investments for longer than a year, it all of a sudden becomes a long-term investment. And if you were to sell after a year, you actually pay less in tax than if you were to sell your investment only holding it less than 1 year. So that would be a short-term capital gain. And it's much higher to pay short-term capital gains. And this comes into effect mostly, again, with like sexy investing. If you're into an app like a Robinhood as an example, and you buy a little bit of stock and then you sell it 4 weeks later, maybe you made a little bit of money, you do have to pay those short-term capital gains taxes on that income. And it's much higher than if you were to have held that stock for longer than a year. And what we're advising at the end of the day anyway is just to hold for as long as possible.
Yeah, this is my hesitancy with the apps, because they are economically incentivized to encourage you to trade more frequently.
Mhm.
And even if they're doing it for free, the way they're making their money is they're actually not giving you the best price on each trade. So there is a cost, even if it's not obvious. And I've seen studies in the past where in times of financial turmoil, the people who came out the best, the retirement accounts that did the best, the segment of the population was dead people. In other words, the people who traded more frequently did more poorly. So I am of the habit of pick a good investment, keep it low cost, set it and forget it, and contribute every month, same amount. Don't worry about what the market's doing. Look to the long term.
All right, I'm gonna switch this to be for both of you, but let's talk about the future and proactive steps. What are some proactive steps teaching artists can take this year to prepare for next year's filings, which I love that the person phrased this, hopefully will include more income from teaching, be that contract or employee work. But I think both from a tax planning perspective and financial perspective, what should folks be thinking about now?
Joe, you want to start with that one?
Sure. Yeah, I can speak to it from the point of view of retirement. So again, educating yourself about these tools that are available to you. One thing we haven't really touched on so much yet are retirement accounts that are available to individuals. And this would be IRA or Roth IRA is sort of my favorite, standing for individual retirement account. These are accounts, so we've talked about 401ks and pensions. Maybe you don't have access to either of those. Maybe you're a teaching artist, you're paid as a contractor, or you're an employee working for an organization that doesn't offer that benefit to you. Every person otherwise does have access to an IRA, these retirement accounts that you can manage yourself. There's just the very few stipulations. You need to be 18 years old, you need to live in the United States and make your money in the United States, and that's pretty much it. And then there are, on the Roth side of things, there are some income levels and things like that to be aware of. But this is a vehicle that's available to everyone. And I'll talk about specifically the IRA, the traditional IRA, we would call it, is a vehicle you can use. You could invest money into your IRA up to $6,000 a year is the cap. And then anything you invest into that vehicle goes against your tax assessment for the following year. So let's say you are a person that makes $50,000 and you put $6,000 into your IRA. When it comes time to do your taxes and figure out your tax assessment at the end of next year, it will look like to the IRS that you made $44,000, 50 minus 6,000. And what that means ultimately is you are paying tax on $44,000, not $50,000. So these tools are useful for many reasons, obviously for the long-term growth potential, for the compound interest to retire on later in life. But in the short term, they can be really useful in lessening your tax assessment so that you are paying less tax in the moment. Versus a Roth IRA is a different version of the IRA where you're actually paying tax on that money, but then it grows tax-free inside of the account. And then when you go to make your distributions later in life, you are withdrawing them tax-free. So there are some options there on the table that speak directly to taxes, obviously, but knowing more about them can help. And this is why the IRS has extended the IRA contribution deadline along with the tax deadline, filing deadline, because it gives you the chance to sort of make those decisions as they pertain to your filing every year.
I would say for this year, the biggest thing I guess I could suggest, if I could suggest one thing, is first thing is get a budget. Do that 30-day exercise and find out what the actual number is. Don't guess what the weather is. Find out exactly what that number is. And then what I recommend is doing something called a reverse budget. So typically what happens is people, let's say we have two accounts. We have a savings account and we have a checking account. And the money comes into the checking account, we spend from it, and whatever's left over, if there's something left over, goes to the savings account. That's how most of us work, okay? What I'm going to encourage you to do is find out what your budget is for that 30 days. And then every week, when you're setting aside to the savings, keep setting aside to the savings. And once that savings account equals your monthly budget, you're going to make a big change. From now on, all of your paychecks, instead of going into your checking account, are going to go into your savings. And at the start of each month, you are going to cut yourself a check or a transfer into your checking of an amount equal to your monthly budget. All right, and you're going to live on that. And every week that goes by, you're going to see that amount going down and down and down, and it's going to keep you in check to make sure you don't go over budget. And what happens here is that over time, as you earn more money, you're saving more and you're not necessarily spending more. You're still fixed here. Once you get this savings up, then you can do things with it. You can start paying down more aggressively your credit card debt. You can pay off your student loans. You can top off your emergency fund, and you can start maxing out your retirement accounts. But the budget, I think, is the central tool in the toolkit here.
Wow. A follow-up question on, I think for Joe, but probably for either of you, is income from stocks in a Roth IRA also subject to capital gains?
Is not, because anything that grows inside of your Roth IRA is completely tax-free. That's the beauty of the account.
Yeah, and I find for most people, if you're young, if you're in your 30s and your 40s, for most people, the Roth IRA is the way to go. Certainly if you're working in the arts. If you're working a high tech, you're working at Google as a high paid engineer, different story. But for most folks in the arts, the Roth IRA long-term is going to be more beneficial to you.
And yeah, to jump on that too, sort of the reason it can be so beneficial, one of the big reasons is we expect that our tax rate will grow as we get older. You expect that you're going to keep moving into higher tax brackets as you hopefully move through your career and earn more income. So the fact that, you in your younger age can put money into this account at a certain, that you've earned at a certain tax rate and paid tax on it already, eventually if your tax rate does go up, you've already paid the tax on it at a lower rate. So you're now withdrawing tax-free. And then you could speculate and say, well, tax rates might go up across the board over the next 20, 30 years. But this vehicle helps you protect yourself against that. So it's this idea that if you think you will go from being a lower income earner to a higher income earner, the Roth IRA is a great option for you. Conversely, and I would say it's a much smaller percentage of people, if you are a very high income earner and you think that you might become a lower income earner throughout your life, then the traditional IRA is probably an interesting option for you. So you get the better tax credit in the present.
Yeah, and also this comes into play once you retire and you're on Social Security, because a portion of your Social Security is taxed depending on your income. And guess what? If you're taking out from a traditional IRA, that increases your income, which means more of your Social Security is going to be taxed. If your income's coming from a Roth IRA, zero income. Okay, you're lowering your tax rates in a whole lot of other ways too. So if you can forego the benefit to your present self and pay it forward to your future self, that's always great if you can do that.
Amanda, do you want to do one or two more from your list in our final minutes?
Yeah. How do artists align their personal ethics around investment to ensure our money is being aligned with companies that are not in contradiction of our ethical standards?
Oh, I love that question. And I'm a big fan of conscientious investing, actually. I just think that, yeah, it is important to sort of marry your personal with the business and sort of money side of your life. I would say look for, again, we're recommending these low cost index funds, but if you're looking beyond that and sort of specifically at what kind of companies you might invest in, think about the future world that you want to live in. There are index funds, for example, that track electric car technology. And so if you're a believer that the planet is better off because we have fewer gasoline guzzlers on the street and more electric vehicles, you might choose to invest in those kind of index funds. And so there are opportunities to do that for sure. And ultimately, you're investing in the market, you are investing in the innovation of mankind, that we will continue to grow and prosper and sort of create growth within all sectors of our businesses. So you are already doing that, but if you want to get even more specific about it, you can invest in all kinds of things, in green energy technology, in things that will make our lives better and the planet better in the future as well.
I have a follow-up question if you don't have any input, Dominic.
Oh, no, I agree. I have nothing to add to that. I wholeheartedly agree. But you need to be aware of the fact that generally those funds will not get the same return as a total market fund.
And they'll carry a higher expense for sure.
They're going to hire a higher expense, and over time that might hurt you in your financial gains. So another way to attack this problem too, sounds really stupid, but vote. Vote, talk to your university, talk to the whoever has your 401k and say, hey, can you make changes across the board? Because if everyone's making these changes, you're not the one stuck holding the bag, because if only one person is doing the charitable thing, you're subsidizing what everyone else is not doing. So, yeah, and so there is, I applaud anyone who wants to invest economically this way. In my experience, the people who can actually afford to do it are wealthy people who have enough stable income right now that they can take a portion of it and say, you know what, we can take this out of the market. We as artists, and especially as younger artists, I'll hide my gray right now, when I was a younger artist, usually are not in a financial position to put our financial buck behind that. So just know that going in.
Yeah, and one last thought I think on purpose-driven investing or how we can better affect the world. You have to evaluate, what can you give? And for some people, it is going to be you can give more of your resources and your money, and maybe for others, it's going to be you can give your time. You might be investing in these low-cost total market funds, but then finding ways to carve out your time to help others by just using the energy of your time.
You think about this, and that's an excellent point, Joe. If you earned more money in the market that allowed you to retire 5 years sooner than you normally would, that's 5 years you could volunteer if you want. And so I think there are different ways to be altruistic with your time, and money is just a translation of your time. This is something that I put my time into, and it's in this form, but I can also have it in this form, me in the present. All right, so I think there are many ways to live in alignment with a life that you want to better the planet.
I have a follow-up, sort of different topic question. With everything that's happened in the change of work structures and a lot of sort of educational opportunities for TAs being offered through 1099 work, I've noticed this amongst my friends in my peer group and just through the grapevine. At what point does it become advantageous for teaching artists to organize their business activities in either an LLC or another sort of business structure? And by that, I mean financially and also tax-wise.
Well, generally, one reason that people want to organize when they're being paid on a W-2 into an LLC, and LLC, the type of LLC we're talking generally is called an S Corp. Generally, that doesn't begin to make sense until you're breaking $100 grand or more a year. Okay, so if you are a W-2 and you have high expenses, then it might make sense to ask the question once you're exceeding 100 grand on a regular basis. As far as doing an S Corp, you're already getting a lot of the deductions that you would normally get from a 1099 already, because you're filing on a Schedule C. And that's the kind of thing where, I would wait till you're earning significant sum of money that way. Okay, $70,000, $80,000 before you even begin to ask that question, because there are other considerations to take into account. When people form an S Corp, there's a cost to it. You have to get it set up properly. The S Corp requires its own tax return every year. You have to file quarterly. The maintenance of it's more expensive. You need bookkeeping, and good luck filing unemployment. You fired yourself? Okay, so these are a lot of considerations. And again, there are a lot of apps and sites that are encouraging you to do this, and how easy it is to save yourself money, and just click here and we'll do it for you. So if you are in that situation where you're considering it, I would advise you to sit down with someone who not only specializes in corporate taxation, but also understands the career that you're in. Okay, but this is not the kind of thing I would do on LegalZoom.
Yeah, and maybe a nice just thought to consider in lieu of this last year as well. Unemployment was made available to pretty much everyone. They cast a very wide net this year because all kinds of people lost all kinds of work, including contractors. That's not a permanent fixture.
That was a new thing. That was a one-off.
It's a one-off. It's likely to be reversed. Maybe it becomes a permanent fixture at some point in the future, but we're not expecting or anticipating that yet. So if you were a contractor, and you were receiving unemployment benefits this last year, it's just a gentle reminder to say you can't necessarily expect that in the future. Typically only available to folks that are working real W-2 earned income in that way. So just thinking ahead, knowing that net was available this year, but might not be available in the coming years to you.
And LLCs or any of the other types of are sort of irrelevant and not really applicable.
That's the reason people do LLC is limited liability. It's not going to save you on your taxes necessarily. So if you are giving horseback riding lessons to children, maybe an LLC is a good idea. Okay, but it's not. You don't approach that from from a financial perspective. It's an S Corp. Yeah.
Abby, turning it back to you.
I was going to say, you can do one more from your list, Amanda, and I think we're almost at time.
I'd say for investing with artists or people in general, what is your general advice around risk tolerance?
Well, the longer the time horizon, the greater your risk tolerance should be. And generally, as far as risk tolerance, this is another thing about index investing, is that if you look at any individual stock, it will go like this. Okay, I want to buy Tesla, Okay, however, if you look at the stocks as a whole, it tends to even out and go like that. All right, so when you are index investing, you're actually index investing, at least in total market index funds, is shown to be a good balance between risk and return, because it's not always just risk. You want to know the return on it, and generally you're going to get the greater returns on something that's more risky. And that gets highly risky if you're trying to pick and choose individual stocks. When you choose a whole group of stocks, you're lowering that risk in relation to the return, and generally that's why, again, I would look up low-cost index investing and John Bogle for a little more reading on this. And Joe, you mentioned, I think, a book that probably addresses this as well.
Yeah. Yeah, and one other term we might throw around is dollar cost averaging, which is just to say you're going to be most successful if you invest in a sort of steady path. To Dominic's point, if we expect the average of the line to just continue to go up in this nice diagonal way, You just want to continue to ride that wave. Sometimes people get into trouble because they try and time the market. You try and look at all those ups and downs and think about when might be a good time to get in, when's a good time to get out. You don't need to worry about any of that. If you can set a schedule for yourself, it's something we said earlier, set it and forget it. Literally means to set your investment up to maybe happen once a month, twice a month, whatever works for you. And then just really never think about it again until maybe the day it becomes time to make those those required minimum distributions. But, you know, by dollar cost averaging, by just getting in a consistent, steady way, you're going to live inside of all of those ups and downs, and you're going to do fine in the long run.
I actually have my account set to have the money go on a Sunday. That way I can't adjust it depending on what the market's doing. It takes the temptation out of my hands completely.
Right.
So.
Thank you both so much. I'm going to hand it over to Kinsey to do our closing remarks. One question that came in the chat, Kinsey, was if folks will get the recording, and I know that we're recording, so if you could include how they can access that in your comments, that would be amazing.
Definitely. Hi, everyone. My name's Kinsey Keck. I use she, her pronouns, and I am the programming and membership manager for the Roundtable. So I've been your Zoom pilot here on this call, and I definitely can say as soon as we have this recording edited a little bit, we will be sending it out. So you should receive a follow-up email next week with the recording. I'll also have the chat transcript available, and I'll pull together any of these resources that we've had in the chat, so you have them right there in that email. I also want to shout out Justin, who put in the chat websites where you can read more about Joe and Dominic. So thank you all so much for joining us today. I want to say a really big thank you, of course, to Abby, Amanda, and Justin, our fantastic Teaching Artist Affairs Committee members. Thank you so much for putting this together and for really running the show. And then, of course, a massive thank you to you, Joe, and to you, Dominic. We are just so grateful for you to take this time and share your expertise and answer our questions. Thank you so very much. Everyone on the call, if you have a couple of minutes, we do have an event survey. We ask everyone to fill out a survey after a Roundtable event just to let us know what you liked, what you'd like to see more of, what you want to see in the future. We really value your input, and it truly does affect all of the decisions that we make regarding future programming. So please, if you have the time, you can do it now. I'll also include it in that follow-up email. And I do want to give a reminder as well that the Roundtable does have a current application out for the Arts Educator Emergency Relief Fund. This is the second round of relief funding that we're doing. You can apply at the link that I just put in the chat. The application deadline is tomorrow. So you have until tomorrow evening to get that filled out, and it's not a whole lot of things. So it's a pretty quick application. If you have any questions about it, you can always feel free to reach out, and we'll help you with that. And I do want to note, I said it earlier in the chat, but I want to say it out loud. The relief funding from the Roundtable is taxable. If you received it already from our round number one, you should have received a document from our executive director at 1099 in your paper 1099. If you didn't receive it, just reach out and let us know, and we'll make sure to get that to you. And then I also just want to share that our annual flagship event, the face-to-face conference, is going to be starting on April 8th. So if you'd like to learn more about that, see our lineup and everything, there's a link in the chat there. And I also want to say that that event is a sliding scale registration option. So we value a registration at $50. You can pay whatever amount of that you want. You can pay nothing. It's up to you. We just want to have our community there. So I've got all those links in the chat for you. I'll share them in the email. Yes, thank you, Abby. The lineup is awesome, but I'll share those links in the chat with you all as well. And that's it. Thank you all again. Have a wonderful evening, and we'll be in touch soon.
Thanks, everybody. Thanks, Dominic and Joe.
Yes, thank you so much.